Hello and welcome to another Securities Lending Live on Saturdays with me, Roy Zimmerhansl. Today, I'm going to be talking about dividends. So, if securities lending is your business or something you're interested in, then this is the place for you. So, let's get to it. There it is. That's what we're going to be talking about today. Dividends. Hopefully, it's some green flowing your way. But let's talk about it with respect to securities lending and what that actually means for end investors. Originally, and last week, I said I was going to cover off both dividends and address dividend arbitrage today. Quite frankly, when I put the slide decks together, there was just going to be too much material. I try to keep these sessions for periods of between 30 and 45 minutes. That just wasn't possible to include all of that. So what I thought I would do is just focus on dividends this week and look at arbitrage the next week. Okay, so we focus very much on dividends today. Bar 19, we're going to talk about a few things here. Number one, the core principle. What is this all about and what are the key concerns for investors? Then establishing the payment criteria. Then we'll talk about withholding taxes. And of course, we're only here for the bottom line. As always, if these videos are helpful, please give us a thumbs up or depending on the platform that you're on. And if you want to see all of our videos and be notified when they come up on YouTube, then please go to YouTube and subscribe. As I said, the channel is just listed below. I'm always interested in hearing where people are watching from. So V is from basically the East Coast of the US, or that side of the country. So appreciate you getting up on a Saturday morning. Yeah, that's fantastic. But I think we get a lot of other viewers in the live sessions, but of course, the majority of people that watch it on replay. Okay. Now the core principle here is if you are an investor and I came to you and said, oh, you can make money from securities lending, but you're going to have to give up your dividend. You're probably going to say, how much money can I make doing securities lending versus how much would I get from a dividend? Almost always, that's going to lean very heavily in favor of getting the dividend. So as a starting point, an investor says, look, I like things the way that they are now, and I'm happy to earn extra fees from securities. But frankly, I can't have my dividend payments impacted at all. And when I say dividends throughout this whole session, I'm also talking about interest payments. So whether you're holding an equity and get dividends, or if you're holding a bond and get interest payments, think of these as being interchangeable for this purpose. Number one, you want to have the investor who's lending their securities be in exactly the same position after they've been lending and you go through a dividend date as if they weren't lending. They have to be in exactly the same position. So before and after has to be equivalent value to them. And you remember all throughout what we've talked about, one of the key benefits of securities lending is that an investor doesn't have to give up any of their ownership entitlements while they're capturing this lending revenue, okay? Because it's always made up economically. So if there's value like a dividend that an investor has foregone because the shares are no longer in custody, that's okay because contractually the borrower has to make them whole. So when I talk about entitlements, which includes dividends, and it's also corporate action. So if there's rights issues or warrants or anything else that changes, stock splits, anything that changes, the borrower is contractually obliged to replicate that. Okay. Again, you always want the investor to be in the same position as they were had they not been lending. Now, you hear these phrases when you're talking about not getting a real dividend. You might hear it called a substitute dividend, or you might call it a manufactured dividend. But the idea here is the before and the after both have to be equivalent. Now, I put an asterisk here beside the entitlements because, of course, they aren't the same. They aren't equivalent before and afterwards because although the dividend payments and interest payments and corporate action recovery are the same, of course, a lending investor is better off than a lender that doesn't invest because the lending investor also gets fees. And even on some of the dividends, they're better off, but I'll get into that later. Now, the one key thing that I want to again point out is that if an investor has loaned out securities, they aren't able to vote them while they're on. Remember, they always have the right to ask for them back if they decide they want to vote for them. Okay, so they can't vote them while they're on loan, but they can get them back to vote. So again, you just have to be aware of that, because there is no way to substitute the value of what a vote is, because what's the value of a vote? You can't really quantify that. Although people have tried, but I don't want to go off on a tangent. But again, assets will be on loan, and then if you want to vote them, you need to ask for them back. And of course, while they're not on loan, you're not earning fees. Again, that's a decision for the investor. Fanny, great to see you again. Thanks very much for your kind words. Yeah, hopefully we'll get these slides out to you sort of Monday or Tuesday and have a chance to look at that. And again, anyone that's interested in getting copies of the slides from this series and the previous series, if you go to this web that I'm showing here, you will sign up for the list. You get one of the downloads, but then the rest of the package will be sent to you in the coming days. Okay, and then you subsequently get any further decks that we do. Okay, so Fanny, good to see you, and thanks for giving me that platform to remind people about signing up for the slides. Okay, of course, it's easy for me to say that an investor will get an equivalent amount, but how do you get to that stage of knowing what an equivalent amount is? So think of it here. Here's the investor that we call the beneficial owner. They're the lenders. You have the hedge funds, who are the end counterparty that's using them or borrowing them. And then you have the two entities, the agent lender and the prime broker, who are negotiating the transactions. Now, when they negotiate that transaction, they agree a number of details. So obviously which security they want to borrow and how many shares, or the par value if it's a bond. They want to agree the collateral type. So they have to know, is it cash or non-cash? And if it's non-cash, there'll be a profile that will have been agreed between the two counterparties. And depending on the collateral type, you'll know whether it's a fee or a rebate, because those things are again, roughly equivalent, and the settlement date. But the other thing that they agree is the net dividend or interest payment that the investor wants. So I'll show you in a minute a few different profiles of investors, but each individual investor has their own entitlement as to what they would get based on the country that they're in, based on the type of entity that they are, and the jurisdiction that they're in, and whether that jurisdiction has a double taxation treaty with the jurisdiction of the asset. So what do I mean by all that? If I'm a UK investor, I might be a retail investor, I might be a pension fund, or I might be a UCIT fund, all right, which is basically a mutual fund, for lack of a better term. That's what they're called in many places, but mostly Europe. So each of those potentially has a different tax profile. And so if you think of the hundreds and thousands of lenders that are in lending programs, each of them with their own profile specific to them. Now, they don't all have different profiles from each other. All of the UCITS in a certain jurisdiction will have the same entitlement when they're holding German shares or US shares or French bonds or Japanese bonds. Okay, so you can do buckets. So when a lender lends to a borrower, they'll be taking assets from a bucket, and they'll say, look, if this investor is entitled to 85% of the dividend of the stock, if there's a dividend. Okay, so that's what they'll talk about. The agent lender will represent what the underlying net dividend requirement or net interest payment will be required by them if the trade goes over a dividend or interest date. Okay, so so you start with the net amount by the investor, and that after-tax percentage is the amount that the borrower will be required to pay the lender as a substitute dividend. And just a point here, the borrower pays the net after-tax amount, okay? The reason that's important will become apparent in a minute. But if a normal process might be, for some countries, that a company declares 100% dividends, then the withholding tax for that is taken by the local tax authority for that country. Thanks for joining, Mike. See you at some point in the future. So the tax authority will take whatever their entitlement is, okay? And then if foreign investors are entitled to some of that tax back, then some of those investors need to make a tax reclaim. Okay, now some countries, they require filings up front that actually says, no, on this type of an entity, I can get this amount right away. And so it's streamlined there. That's called relief at source. Again, I'll come back to that in a minute. But basically, the borrower and the lender agree, and that agreement includes what the net dividend requirement is for that lending investment. Okay. And that's, of course, payable on the payment date. Now, I don't go into that in this session, but there is a reconciliation process as you go into to a record date, then record date to payment date, and then when the two parties, the agent lender and the borrower, reconciling positions. I borrowed X number of shares from you at Y amount of withholding tax and Z withholding tax, because they might have clients where they've loaned the same stock with different underlying tax profiles. So there's a reconciliation process. And what that does, if both sides do it, that enables the borrower to pay on the due date. So again, it should be a straight cash flow payment, agreed, accepted, and paid out to that end lending investor in exactly the same way as if the assets were still in custody. Okay. So that's how you figure it out. You basically agree with your counterparty. Now, you can imagine that this is a day one arrangement. If one of these beneficial owners changes because they've sold it, and now the agent lender has to substitute beneficial owner 2 for beneficial owner number 1, they might have different tax profiles. So although the prime broker might have the trade booked correctly on day 1, on day 2, the agent lender may have reallocated that and the prime broker won't know that. So that's why reconciliations are so important. That's why post-trade automation is really critical, because people will have hundreds, thousands of securities on loan from hundreds or thousands of underlying clients. So you can imagine how that kind of mushrooms into potential operational problems. So reconciliation along the way is always super important. Now, let me just switch to withholding tax and withholding tax differentials. The first one, the first category up top, these are investors that are tax exempt. So there is an agreement that if I'm an investor in a French company, that because of my jurisdiction and because of my legal status, because I'm a certain type of fund or a certain type of investor, the arrangement between the UK government and the French government is that I won't suffer any withholding tax on my dividends or interest payments, because there's some examples where there's no withholding tax on fixed income instruments, but there is withholding tax on equities. I'm not aware of any situations where there's no withholding tax on equities and there is withholding tax on bonds. Maybe someone in the audience can point that out, but I'm reasonably certain that doesn't exist. So they are, from an investor point of view, that's fantastic, because as soon as you start suffering tax or fees or whatever, that eats into your returns. So if you're tax exempt, fantastic. Then there's investors in countries with what we call treaty relief. And that's where there's a double taxation treaty in place that reduces the entitlement. So most countries will have double taxation treaties in place. The question is, to what extent is it advantageous from a tax perspective? And in this case, there are situations, and this is for the majority of institutional investors, there is usually some element of reduction of withholding tax, again, depending on your jurisdictions. And so that's why the final example exists, the tax disadvantaged investor. So there's no double taxation treaty relief there, no agreement in place. And the reason I have that pick is not because I'm longing for a holiday on a beach, although I definitely am longing for a holiday on a beach. But usually, if you're going to get countries without double taxation treaty benefits, they tend to be in some of the offshore tax haven locations, the various Caribbean islands and other similar countries around the world where there's no double taxation treaty benefits in place. People will associate this with beaches and sand and sea. And I guess it's not such a bad thing being a tax disadvantaged investor if you're being disadvantaged while being on the beach. So these entities will suffer maximum withholding tax. And on the next slide, I'm going to go through the numbers and we're going to get practical to show what this really means. But those are really the three categories. You're either exempt from tax, you get some tax reduction, or you suffer maximum withholding tax. So you can imagine there's all kinds of investors that fit into all three categories, and that has an impact on the business. If I go to the next slide, and let's get practical here. Okay. We have those same three investors: tax exempt, treaty relief, and tax disadvantaged. And the example we're going to work through is Coca-Cola, because I've got another Coke with me. Who knows, someday. Anyway, I'll have a quick drink. The other reason I've chosen Coca-Cola is because Coca-Cola is a fairly high dividend paying company. As it shows here, they have increased their dividends for 59 consecutive years. And at the moment, the stock yields around 3%. So I've did a bunch of rounding here. So in the example and the figures that I'm using, Coca-Cola is yielding 3% on dividend. The stock's around $50, which suggests a dividend of around $1.50. Those aren't exact numbers, they're approximate in the area. So what we're going to do is start with this base amount. So that $1.50 dividend, of course, that's the entitlement for everyone that's an investor in that stock. And so if I'm an investor in the stock, I've loaned it out, the starting point is $1.50. If we now then look at the tax amount here, this tax exempt entity, of course, suffers no withholding tax, so there's no tax paid. The middle one, in a typical example, if you start at $100 and the maximum withholding tax usually is 25%, there's countries where it can be 30%, but really it's typically around 25%. So if you are fully disadvantaged, this bottom category, you suffer 25% withholding tax. And again, although it varies, the withholding tax for this entity that gets some kind of relief, they can get 10% of the withholding tax better. So it goes from 25% withholding tax to 15% withholding tax. So they are 10% better on the dividend. And I just show the numbers here. So on $1.50, obviously nothing. For this middle category where it's 15% withholding tax, that would be 22.5 cents withholding tax. And for the tax disadvantaged investor, 25% withholding tax equates to 37.5 cents. So the net entitlement is obviously no withholding tax. They get the full 150. They get 127.5. They get 112.5. So you can see it's obviously a 25% variation. That's a pretty big difference because the borrower has to pay whatever that investor is entitled to. So obviously, what they want to do is figure out how much each of these things cost. Yes, I love the example of Coca-Cola as well. Thank you. I'm in a lifelong love affair with Coca-Cola, I have to admit. And I still have my teeth. So the tax exempt investor, 150, then 127.5, 112.5. If we use an example of the same Coca-Cola stock and a loan transaction of 100,000 shares, then what that equates to in the borrower making a cash equivalent payment, that's $150,000 or $112,500. That's clearly sort of $37,500 different. That's a big amount on what's a relatively small trade, right? So 100,000 shares at $50, only a $5 million trade. So it's not the biggest trade in the world, but $37,500 effectively of profit disappears if you're borrowing from the tax investor rather than the tax disadvantage. And of course, the one that gets the tax relief in the middle, somewhere in the middle there. So it is a really important consideration, and borrowers are constantly looking at upcoming dividend dates and trying to figure out the best lenders to have borrowed from over those dividend dates. If you look at the bottom line of this, the investors are receiving equivalent payments as if they weren't lending. That's what they're trying to do. So in this example, this is what they would have got if these assets were just sitting in this investor would get 150 and they'd all get those equivalent payments, and they get that on due date, or I'll tell you about in a minute, tax relief and tax reclaim. So those are the amounts that have to be paid, and the borrower has to pay them. So there will always be demand to borrow from tax disadvantaged lenders. So forget about arbitrage. We'll talk about that, as I said, next week. There is always a demand to pay less. I'd rather pay 112,000 and a half than 150,000. Why would I want to just give money away? So of course, I'm always going to try and look to substitute that just because it's straight up cheaper, right? Now, of course, the other thing is that if I'm a lender of tax disadvantaged assets, of course, I know that it's cheaper and that borrowers are going to demand the stock from me rather than somebody else. So, of course, I'm going to capture or try to capture additional fees. I might add a few basis points on to make certain my fees are higher, because why wouldn't I? Because as long as the combination of the net dividend amount and the slightly increased lending fees is less than the straight up payment to the entity that they're making, they should, in theory, if they're economically driven, substitute me in for the lender. Okay. This plays out in a number of different ways. So number one, it's not as simple as just substituting. It has to be available. You have to have the lender approving the borrower, approving the lender, and having credit limit available. There's also transaction charges that get involved, which I haven't accounted for here. So there's a lot of different factors. There's also stability and lender relationships, all of that. So there's a number of different factors, but if you were purely driven by the economics, you're always going to try and substitute out. Okay. I hope that makes sense. I didn't even play this video. Look at this video. I had to find this, the whole idea of counting the money. Anyway, show me the money and show me the cheaper dividends. That's what I say. There's also a time advantage for some of the loaned assets. So remember I said the borrowers are required to pay on the payment date. That means that the lender gets the money on the date that they would be on the day that the company pays it out. So that's terrific, except not every market would pay that money out on the day. So forget about securities lending. If they were just sitting in custody, just holding those assets there, there's two kinds of tax reclaim. So obviously, if you're tax exempt, you'd get the full amount right away. Usually they have special arrangements. But if you suffer withholding tax and you're entitled to some of it back, there's two different ways to go through that. One is some countries operate a relief at source. So if you are tax exempt, or if you are entitled to some of it as a return, so these first two categories, no withholding tax at all, or reduced withholding tax. And again, that's going to be the majority of investors in the majority of markets. So this really is important. So these people shouldn't suffer any withholding tax or a reduced amount. So in a relief at source market, that's what happened. So if I'm an investor in that market, I have to provide my custodian in that market with all of the necessary tax documentation to say, Roy is entitled to reduced withholding tax in this market. And if the local custodian, who probably acts on behalf of the tax authority as a collection agent in that market, if they're satisfied with that paperwork and I'm entitled to 85% of the dividend, I'll get 85% of the dividends right away. If I'm tax exempt, I'll get 100%. If I'm not entitled to anything, then they'll obviously keep the maximum withholding tax that's appropriate. So that's many markets, and that's quite efficient because everyone ends up where they should be. Of course, there are countries, many countries, and large countries who say, we're not just going to give you relief up front. What you have to do is you have to give me a reclaim. So we're going to take all of the tax up front, and then we'll refund you after you've made your claim, and if we agree with the paperwork and the claim. And as I said here, some can take up to 18 months. In fact, some can go longer than that. Some will be shorter than that. But whatever it is, it's measured in months, not days. And so what that means is that if a borrower is paying a lender, the net position on payment date, that's up to an 18-month example of, or 18-month advantage from cash flow. So in my example, the middle investor here, who's entitled to the 15% withholding tax rather than 25%, that means that in if it was in custody, they would start off only getting this amount, and then 18 months later they would get that amount. Actually, this is the cash amount that they would get immediately, and they would get an extra $15,000 at whatever time frame, 6 months, 12 months, 18 months. So they have the advantage, and obviously it's a bigger advantage for those that have no withholding tax at all. So these entities, of course, they have the advantage of getting that $15,000 up to 18 months earlier than if they do a reclaim. And as they say, time is money. So you want to always try to get your money in as soon as you can. If assets are on loan, securities lenders actually get a time advantage for tax reclaim markets. Okay, that's super important. People don't always think about that. Okay, so you not only are collecting fees, but you can accelerate the payment of your dividend. Okay, the course that I was talking about, let me just switch gears for a second. The course I was talking about that I just taught was this one. I'm really sorry about that. The course I'm talking about is the Introduction to Financial Markets and the Role of Securities Lending. So what I did in that course was, as for people that are relatively new to markets or just want to learn a bit more, what I did was I looked at sort of financial markets generally, but specifically equity markets, bond markets, and asset management. And what I tried to do was tie in the activity between the market functioning itself and the role that securities lending plays in that. And then, so that was 4 hours of discussion about capital markets, 4 hours of subsequent lectures on securities lending. And then there's another 4 hours coming in 2 weeks so that people could assimilate what they've learned and come back with questions and learn more. So I'm also going to be turning that into an online course. So if you have friends, family, contacts that are newbies, but it is done from a securities lending point of view. So I'm sure there's better courses if you just want to learn about equity markets or just learn about bond markets. The focus here is learning a little bit about equities and bonds and how they tie into securities lending. So it's very heavily on that. We, of course, always have the free primer, and lots of people that are viewers and subscribers of this have taken the course. I hope you got value out of that, since there's still subscribers or they're too lazy to unsubscribe. And then there is the fully blown in-depth course, which goes much more in depth than I do in these sessions. And that's also available online on demand. I'm thinking of doing in-person courses again, though, because I quite enjoy the interaction. I don't know. Let me know what you think. Would you go to an in-person course now, or are you still concerned about gathering in crowds? Interested in hearing what you have to say about that. So going back to today's session, we looked at those 4 things, as I said. Number 1, we are going to talk about that an investor obviously has to be in the same position that they would be if they weren't lending out. Otherwise, they just wouldn't do any lending. Okay. So that's a fundamental aspect, and that the lender's net requirement is part of the trade negotiation when the borrower and lender start their discussions, so that everyone's very clear about what the investor is expecting to be paid, and the borrower is very clear on what they're going to be required to pay. Of course, again, as I said, the borrower is going to manage it so that they find the optimal position between saving money and costs and relationship. So often the net positions take into account, obviously, the withholding tax of the individual underlying investor, which is a combination of their jurisdiction, the treaty arrangements between their jurisdiction and the jurisdiction of the asset, and their structure and legal entity type. So that's what net positions go into. And investors that suffer maximum withholding tax or more withholding tax will always be more attractive over these dividend payments than someone that suffers no withholding tax or less withholding tax. That's just economics. And then finally, the point is that investors will always receive the equivalent value of cash payments. And in fact, some of them might be even better off because the payments are being accelerated. Okay, so that's what we talked about. Next week, I am going to talk about dividend arbitrage, the good, the bad, and the ugly. So is a dividend arbitrage transaction, is that okay? Is that on the side of the angels? Or is it on the side of the devils? Who knows? I look forward to next week and exploring that with you. I hope you have a great day. Thanks very much for being with me today. Have a great Saturday. Have a great weekend. Have a great week. And I look forward to seeing you next week.